Hello and welcome to my brand new channel, Global Dividend Strategy. I'm excited to discuss various topics with you, including dividend stocks, market news, tech stocks, and how they can be utilized to maximize your dividend stock acquisitions, international migration and taxation strategies, and much more. My goal here is to help you achieve financial and geographic freedom. So today I want to talk about some recent developments regarding BCE or Bell, particularly the acquisition of Ziply Fiber in the United States for roughly $5 billion Canadian, along with taking on $2 billion of its liabilities. This significant move has caused quite a stir up in the market since it was announced on Friday afternoon. As we can see here in the chart, there was just a steep price drop from roughly 44, high 44s to low 41s, so by about 10%, and the price continued to decline in this week on Monday and Tuesday by another 2% or so, down to the 39s. So actually now the dividend is almost at 10%. As we can see, it pays $3.99 per share, and the price is now $39.92. That's actually more than 10% now. So why did the price take such a big hit? Part of the reason also lies in Bell's announcement that they will pause dividend increases until they can reduce their payout ratio to a more sustainable level. As just mentioned, the dividend is at about 10% currently, which is the highest dividend I have ever seen being paid by a blue chip company, which of course could raise concerns among some people about its sustainability. However, if we look at the dividend history here for Bell, we can see that it generally just always goes up and up. We're now down to 2019, right? So we haven't seen any increases. It's just increase here, increase 2, 4, 5, 7, 5%. I haven't seen any cuts yet. Oh, here we go. In the 2000s, there was a cut of 11%, right, when there was the tech bubble, which is arguably the biggest recession, at least for the tech and communication sector as well, that we ever had. And again, it was just cut by 11%. So even if they cut it now by 11%, which I don't see them doing because their financial position is still quite strong, it would only go down to like 9% dividend, 8.8, which is still great. So popping here over to another portal, we can have a brief look at the finances for Bell. We can see that the main metrics like revenue from 2016 to 2023 have been increasing steadily. The only time it went down a little bit was during 2020. Which is not a surprise. And then I'll just scroll down here so you can have a brief look at all the other financial metrics if you want to pause your screen and have a deeper dive into it. And another thing I want to show you is the earnings expectations for the November 7th announcement, which is actually 2 days away. If we're looking here at earnings per share, last year we were at 81 cents. Now the expectation is 77 cents. So that's a decrease. Same for revenue, a decrease from last year. So what does this mean? To me, it means that the market expectation is not overly bullish for Bell, which means it will be easier for the company to meet those expectations and avoid shocking the market and causing further downward price action. And also, just to add, this in itself could have been another reason that the price for Bell decreased so much in the last few days, as usually there is market volatility before announcements happen. So with this being said, I believe the market overreacted to both the acquisition and dividend announcements, as I have a more longer term perspective myself. I believe this acquisition makes strategic sense for Bell Expanding its market share into the United States opens up access to additional customers, which could lead to greater revenue streams in the future. And the pause in dividends increases is also not necessarily a negative signal. In fact, it could reflect positively on BCE's financial health over the long term, because by prioritizing financial stability, they can work towards a more sustainable payout ratio, which is ultimately going to benefit investors down the line, and they can allocate more money to their expansion efforts, which of course is as well going to reflect positively on their future as they're taking more market share and becoming the leading fiber optics provider in Canada, and now even trying to enter the United States. So as for my own investment strategy, I already have a sizable position in Bell, and while the 9.8% dividend yield is incredibly attractive, I'm choosing to hold off on dollar cost averaging into my existing position for maybe a week or two, as I want to observe how the market reacts further to these changes before making any additional investments. In the meantime, I'll be exploring other great dividend stocks that may provide better opportunities. However, I must say the lure of the high yield is hard to resist, especially when considering Bell's long-standing reputation as a reliable dividend payer. And that could be changing, and I could actually be buying more Bell shares sooner than I'm currently thinking. For anyone new to investing or considering adding Bell to your portfolio, I always recommend doing your own research to ensure that your decisions align with your individual circumstances and financial goals. So I hope you found this information informative. If you did, please hit like and consider subscribing for more content like this. I really appreciate your support as I work on building my setup, editing skills, and refining the structure of my content for you. Thanks for watching, and I'll see you in the next video. Take care.